Oh, hello, welcome back to Principles of Accounting 1. I am your host, Dr. B. We are in week six of an 8-week course. Unbelievable, right? Time goes by so fast, doesn't it? I want to quickly recap where we are in the classroom and then we'll get talking about current liabilities and payroll. Very, very fun and exciting topics. Where are we in the classroom? So we're in week 6 of an 8-week course. That means we are in module 3, week 6. We're going to talk about current liabilities and payroll, which is chapter 11, and then we'll do chapter 12. For this week, for this chapter that we're about to talk about, chapter 11, which is current liabilities and payroll, there is a discussion forum. Discussions are required. And I'm requiring you to write full paragraphs. Okay. Uh, it's a discussion. Should be full paragraphs, and did a wonderful job with this discussion. Looks like last night. And Dua has a very nice lengthy paragraph here, and also has some outside resources. So this is what I'm looking for. Yeah, in your initial post. I recommend that you do that one as soon as possible. Yeah. Do your initial post as soon as possible so that way you'll have time to respond to two of your classmates. And so when you respond to two of your classmates, make sure that those are also full paragraphs. I don't accept one sentence, two sentence, three sentence. Those aren't paragraphs, yeah? A paragraph is multiple sentences, not just one, two, or three. That's not substantial. So yes, discussions are required. Yes, they should be full paragraphs and include outside resources wherever possible. That is very, very important. So the discussion on today's topic is going to be around payroll. So it's a really good discussion overall because it affects all of us. So please, if you can, do your primary discussion early and then respond to two of your classmates. But of course, all that's due by Sunday night. So let's go ahead and talk about current liabilities and payroll. So, also, I want to quickly mention thank you for those of you who were able to complete that mid-semester survey. The mid-semester survey is really important because it tells me what I'm doing right and what I'm doing wrong. And it helps to facilitate the rest of the course. And so what we're going to do from this point forward is we're going to make this more interactive. Because one of the most important comments I saw from the mid-semester survey is a lot of you are looking for more hands-on interaction. And so that's what I'm going to do. Yeah, that's the whole idea behind the mid-semester survey is it allows me time to pivot. And so from this point forward, we're going to do a lot more interactions together. Because I think that's how we all learn, right? So let's do that, and I'm going to start with this first question to you all, and please feel free to unmute your mic and respond to the question accordingly. So the first question I have for you is, what is a current liability? What does it mean to have a current liability? What does the word current mean? Who can tell me? Who can tell me what does the word current mean?
Current is present day, actually going on, currently going on.
Yeah, that's part of it. So in accounting, what does current mean? What does it mean to be current? What is a current liability?
It's on the books for the month.
Up to date.
For the month? Yep. That's all correct. So current. In accounting, we think of the word current as being 12 months or less. 12 months or less. So the word current means 12 months or less. It means it's current. It's currently due So you're all on the right track. Yes, it's for the month. It's currently happening. Yes, those are very true statements. It's also in accounting. It means 12 months or less. That's what the word current means. We have current assets, which are cash, accounts receivable, uh, um, inventory, etc. Right? Those are current assets. We also have current liabilities. Current liabilities, those are things, as you recall, a liability is what the business owes to someone else. It's what we owe to someone else. That's a liability. A liability is when you owe something to someone else. That's a liability. Okay? So, current liability is a liability that we must pay within 12 months or less. That's what makes it current. And there's a lot of different current liabilities. We have accounts payable, wages payable, anything payable within 12 months or less. That's a current liability. So we'll break these down and talk about them and give you a couple examples. I'll ask you a couple questions along the way. Because again, we want to try to make these courses more interactive as we can. Yeah, that's based off of your feedback from the mid-semester survey. So the word current, as we described, means 12 months or less. What do you think long-term means? What is a long-term liability? Go ahead, Nick.
A year or more.
A year or more, that's correct. Can you give me an example of a long-term liability? What would I be paying on for more than 1 year?
Insurance, I guess. It'll be renter's insurance.
It depends. It depends. It can be current or long-term for insurance. It depends on the policy, right? If the policy is for greater than a year, then yeah, it's long-term. If it's less than a year, then it's current liability. But that one gets a little tricky, but you're on the right track, Nick. What else might we be paying on for more than 1 year? What do y'all think? Current liability. Sorry, long-term liability. Johnny.
Like a mortgage?
Mortgage, yes, 100%. 100% correct. Yeah, mortgage, most definitely. What else? What else do we pay on for more than 1 year? Mortgage, definitely. What else?
Possibly a car note or
Yes, car note. 100% correct, Nick. Yeah, most definitely. A mortgage, a car note. How about student loans? Yeah, yeah, probably. Unfortunately, but yeah, they typically we pay on those for more than a year. Yeah, so long-term liability is anything that we pay on for more than 1 year. Common examples: a car note, a mortgage, a student loan, a business loan. Usually we call these notes payable. Notes payable. Those are long-term liabilities. But yeah, you're right. So current liability means it's a current obligation. Okay, current obligation. That's a current liability. We have to pay it within the next 12 months. That's a current liability. A long-term liability is a liability that we pay on for more than 1 year into the future. That's what makes it long-term, yeah? So there's a couple of things that happen here with liabilities. A liability can become past due, meaning, we forgot to pay that one bill, and so they sent us a second notice that now says it's past due. That means it's late. Yeah, it was due on a certain day. We didn't get it done on that day. We didn't pay it on that day, so now it's past due. And when it becomes past due, sometimes the vendor, the supplier, they might say, "Hey, you know what? It's past due now, so now you owe us interest on top of this." You know, that happens from time to time. Or they'll hit us with a late fee. Ooh, the late fee. I hate late fees. But yeah, they'll hit us with a late fee. It's kind of like if you're late on the discussion forum that's due this Sunday night, I'm going to hit you with a late fee. Okay, I've got points for being late. Yeah. Hit you with a late fee. Right? But the same concept applies. Do it on a certain day, you didn't get it done on that day, I hit you with a late fee. Yeah, it's past due, hit you with a late fee. Yeah, banks do the same thing. Uh, if you're late on a bill, you get hit with a late fee or with an interest increase or whatever. Yeah, past due. Present means it's due now. Okay, it's due now. Present or current liability, it's due now. It's due within the next 30 days. It's due within the next year. Current. Long term, it's greater than 1 year. I usually make monthly payments. We call these installment payments. Yeah, monthly installments or monthly payments. Uh, those are typically done on liabilities that are greater than 1 year, long-term liabilities. Sometimes, and I'll also mention this one where it says future. Sometimes with insurance, Nick, you brought up insurance. Sometimes we do what with insurance? Before we consume it, what do we do with it?
Paying it ahead.
We're paying ahead. So Johnny, what does it mean when we pay ahead? What's that word? What's it called?
In advance.
In advance, yep. And paying ahead, it's in advance. We call it prepaid. Prepaid. We prepaid it. We prepaid it. It means we paid it in advance. Yeah, we paid it ahead of time. We prepaid it. Examples that are prepaid insurance. Okay, prepaid insurance, we pay for the insurance that we're going to consume later. That's a prepayment. Yeah. So that's an example of a future payment for a service. We prepaid it, paid it in advance. So let's talk about some more liabilities. So we mentioned that, I'm sorry, current liabilities, these are payments due within 1 year. So in the next 12 months, I got bills coming up. Those are all current liabilities. Okay, I'm going to pay them within 1 year. Yeah, within the next 12 months, I'm making the payment on that. That's a current liability. Long-term liabilities, we had said as payments greater than 1 year. Can anyone give me some examples in business that are current liabilities? What are things that I would pay on over the next 12 months in business? What are the kind of things that I would make payments for?
Employee wages.
Yeah, wages. Absolutely, 100%. Yeah, we call those wages payable, and those are current liabilities. Excellent. What else? What kind of monthly bills do we experience in business?
I mean, any type of utilities.
Utilities, yeah, absolutely. I got to pay my electric, got to keep my lights on and my water flowing. Yeah, utilities, those are current liabilities, and we call those usually fall under accounts payable. Yeah, excellent point. Yeah, those are all examples of current liabilities. I pay them within 12 months or less. Wages, utilities, I could keep going on and on. Things I pay with. I could get a bill from a vendor because I purchased some inventory on account. Yeah, that's accounts payable. Got to pay that. Yeah, those are all current liabilities. And then long-term liabilities are things I pay on greater than 1 year. You all came up with good examples. Johnny had mentioned a mortgage. Yeah, that's a long-term. A car note. That's a long-term. Mortgages and car loans, those are long-term liabilities for the business, yeah. Other long-term liabilities might include what we call a note payable. A note payable, that's like a bank loan. Yeah. A bank loan, that's a note payable. Went to the bank, got a loan for 5 years, that's a note payable. Yeah, those are all long-term liabilities. Pay on longer than 1 year. Okay, so current liabilities due within a year, long-term liabilities due greater than 1 year. This cute little visual for the bottom here shows us some percentages as it relates to the financing. Yeah. So we have Columbia, Bowling America, Apple, Six Flags, and the percentages show us the percentages of their liabilities. Yeah. And that's kind of what that chart shows us. We don't have to worry too much about it. It's a nice visual. Now, here's the thing with liabilities that you probably are aware of. Sometimes we might get a bill in the mail and we don't know who the hell to pay. It'll show up with an address, it'll show up with an amount, but that part that says make checks payable, it's not there. So I don't know who to write the check to. So sometimes there's uncertainty in liabilities. One of those is we don't know who to pay. Okay, that happens from time to time. Another classic one: you might receive a bill in the mail, and it'll say due upon receipt. Well, what the hell does that mean? Due upon receipt. I don't know what that means. Uncertainty of when to pay it is an uncertainty in liabilities, right? It's like, just give me a due date. Don't tell me due upon receipt. I don't know what that means. Due upon receipt. Upon when I receive the goods? Or when I receive the bill? How am I supposed to pay right away? What does it mean? Upon receipt. Just give me a due date. Yeah. So sometimes there's uncertainty of when to pay the bill. And every so often, there's uncertainty in how much is owed. Okay. Now here's what I mean by that one. Because usually when I get a bill in the mail, it tells me how much I got to pay. It's usually a pretty exact amount. Okay. But sometimes that may not always be clear. For example, and this is a very true story. Just the other day, I got a statement in the mail from my dentist, and it showed all of the transactions I've made with the dentist and the insurance company for all of 2022. And it says I owe them money. I owe them $75. Okay. I don't think I do. I don't think that's correct. So I called them yesterday and I said, hey, I got a bill here. It's a statement. And it shows all the transactions. And I'm very confused because it shows a balance forward at the beginning of the year, and then it shows all these adjustments and all these charges, and I have no idea how to read this damn thing. So I called him and I said, hey, it says I owe you money, but I don't think this is accurate. And so the lady goes, the lady who answered the phone, she goes, well, your wife was just in here, and so we'll wait because we have some pending charges with the insurance company. So that made it uncertain as to how much I actually owe them. Now, that's one real life example that literally just happened to me yesterday. Another example would be, let's say you purchased some merchandise from your vendor, some inventory from your vendor. You're gonna sell the inventory, and your vendor says, "Hey, if you pay me, you see where we're going. If you pay me within 10 days, the first 10 days, I'll give you a 2% discount, 210 net 30, right? You pay me within the first 10 days, I'll give you a 2% discount. Otherwise, the whole thing's due within 30 days. Sometimes that makes it uncertain of how much to pay. If I pay it within the first 10 days, I get a 2% discount. Otherwise, I owe the whole thing within 30 days. So that kind of makes it uncertain. Because if I pay it within 10 days, 2% discount. If not, whole amount. So sometimes there can be uncertainties in liability. So how do we know which liabilities are current and which ones are long term? Well, we already know that if it's due within the next 12 months, it's current. Examples of current liabilities include things like accounts payable. You already know that accounts payable includes all those bills that you get that you haven't paid yet. Just got my electric bill the other day, haven't paid it yet. It's an accounts payable. I just got my water bill the other day, haven't paid it yet. Accounts payable. Internet bill the other day, haven't paid it yet. Accounts payable. Those are examples of accounts payable. Or I place an order with my vendor who's going to supply me my inventory. Haven't paid them yet. That's accounts payable. Now, what about this one? Sales taxes payable. Who can tell me? What do you think sales taxes payable is? What is sales taxes payable? What is that? What is that account? What's in that account? Sales taxes payable. What do you think? Johnny?
The tax that you have to pay up front, like when you buy something, might not be on the label, but you know you're gonna have to pay tax when you buy it.
Yeah. Yeah, that's definitely part of it. Nick?
I kind of same thing. I guess you said payable, so I would guess the sales tax you may owe.
Correct.
Correct.
Yeah, that's right. That's 100% correct. So think about it. Pretend you're a retail business, okay? Let's say you sell tourist stuff to the tourists in DC down at the National Mall. Okay, you got yourself a cute little stand, or maybe it's even like a food truck, but you converted it into a retail stand. Okay, and you're down there at the National Mall and you're hustling the tourists and selling them all the DC junk, right? And so you're down there. So every sale that you make, it doesn't matter whether you charge them with a card or they're paying you cash. You have to pay sales taxes, right? So what do? You collect the sales tax from your customer. So, for example, let's say they go, oh, I like that DC T-shirt. They go, how much is it? And you say, well, it's $20 plus tax. Okay, plus tax. So they'll pay you the 20 plus the tax. So they'll pay you, we'll say it's $22.50. The $2.50 is the sales tax. Okay, you have to remit the sales tax to DC government, right? That's to the Treasury. You have to pay the DC Treasury the sales taxes that you collected from that customer. Okay, so you have, what you did there is you generated the sale, the $20 sale, okay? But when you sold the product to the customer, you also, in that instance, generated what's called a sales tax payable. You collected the $22.50 from the customer. 20 of that dollars is the sale. The $2.50, that is sales tax payable. Okay, so the way you'd bring it up is, or the way that you would do the journal entry is, you would debit cash $22.50 because you got $22.50 coming in. You would credit sales, $20, because you sold the shirt for $20. Then you would also credit sales tax payable, $2.50. So you see how it balances. But what that did is it generated sales tax payable. Now the way it works is, and this is the way it works in real life, every quarter, so every 3 months, you have to pay the sales tax to the DC Treasury Department. Okay? And so you would take everything you have in sales tax payable, debit sales tax payable, credit cash to pay the sales taxes to the DC Treasury. Make sense? So the way to think about it is you as the business, you're the intermediary when it comes to taxes. You charge the tax to the customer, you collect the tax from the customer, and then you give that same amount to the tax agency. You know, that's the way it works. That's the way sales taxes work. So when you pay the sales tax, the business holds on to that money, and then they remit that money to the tax agency. Yeah, that's how it works. It works the same way in payroll, and we're going to talk about that soon. Unearned revenue. You can tell me. We talked about this. I know we did. Remember the lawn service that we had a few weeks ago? You can tell me, what is unearned revenue? Unearned revenue, what is that? What is unearned revenue? Don't you all shout at once. Nick.
Money you have not earned yet, revenue you have not acquired.
That's right. So that's correct. We collected the cash from the customer up front, but we have not yet earned it. We have not yet earned it. What does it mean to not earn it? We collected the cash up front from the customer, but we haven't done what yet?
We haven't done the service yet.
We haven't done the service yet, Brianna. Yeah, exactly. I collected the cash from the customer for the lawn service, remember? Oh, they pay me up front on the first of the month, and then throughout the month, I'll mow the lawn. It's unearned revenue when you collect payment from your customer, but you have not yet provided the good or the service. That is unearned revenue. Very good, very good. Excellent. So unearned revenue is a liability. It's a liability. The reason why unearned revenue is a liability is because the customer can come back to you and be like, hey, you know what? I don't need your services. Give me my money back. Give me a refund. That's why it's a liability to the company. Unearned revenue is a liability to the company because the customer still has a claim to that revenue until you provide the good of the service. When you provide the good of the service, then it becomes revenue through adjusting entry, right? We debit unearned revenue and credit revenue through the adjusting entry when we earn the revenue. Yeah. So unearned revenue is a liability until it becomes revenue. Short-term notes payable. Okay. This is probably a new term to y'all. Short-term notes payable. A short-term notes payable is a short-term loan. Usually 90 days, 30, 60, 90 days. It's a short-term loan. It's not like a payday lender, kind of is. But the interest rates are high too. But it's a short-term loan. A short-term notes payable, that's a short-term loan. You went to the bank to cover payroll for next month. That's a short-term loan. You'll pay them back plus interest. That's a short-term loan. That's just what a short-term notes payable is. It's a short-term loan. Very simple. payroll liabilities. Now, this is important. Payroll liabilities. Payroll liabilities is to pay our employees. Our employees work, okay? They punch the clock. They record their hours using the punch in, punch out system that we got going on. It records the hours that they work. Every 2 weeks, I pay my employees. During those 2 weeks, we accrue the liability, the payroll liability. Where every time they punch out, I record the hours that they work, and that's a liability for me, the company, because they work, I have not yet paid them. They worked, I have not yet paid them. That is called a payroll liability. They work, I have not yet paid them. It's a payroll liability. Every 2 weeks, we accrue the hours that they work, and then we pay them after they've worked. But because we haven't paid them right away, it's a payroll liability, you see. So that's what a payroll liability is. It's monies that we owe to our employees for the work they have accrued. Payroll liabilities. And there's a few within there, and we'll talk more about that. And the last one on this list is called a multi-period known liability. Multi-period known liability. This one's kind of obscure. There's a few liabilities that probably fall in this category. But multi-period known liabilities, those are, I call this the monthly payments. Okay, that's why it's multi-period. Monthly payments that we have to make, the company makes. Examples would be rent. Yeah, rent, the mortgage payment, the car loan payment, payments to Social Security. These are known liabilities that occur over multiple periods of time. Think monthly payments when you see multi-period known liabilities. Monthly payments. So, going back to our sales tax example. Okay, here's an example. This is just this very simple example. This is probably from like one sale, would be my guess, because the dollar amount's pretty low. August 31st, Home Depot sold some materials to a customer for $6,000. They have a 5% sales tax. So they collect $6,300 from their customer. How we got $6,300? 6,000 times 0.05 is the sales tax. That's $300 on a $6,000 bill. So we collect the cash from our customer, $6,300. So we debit cash, $6,300. That's the cash we have coming in. Then we credit our sales, $6,000. We sold $6,000 worth of stuff. But then we credit $300 to sales taxes payable. Sales taxes payable is a liability account that represents the sales tax that we have collected from our customers but have not yet paid to the tax agency. At the end of every 3 months, we will pay all of our collected taxes to the tax agencies. Unearned revenue. We've talked about this one a few times. Selena Gomez. Oh, one of my favorites. So Selena Gomez comes to town. And so she sells out a concert venue, or was close to selling out. The total ticket sales were $5 million for this one show. Okay, bitch, probably egg. Oh, this is 8 concerts, but I think it's a lot. That's more like 1. But we'll say it's 8 for the sake of argument. So over 8 concerts, Selena does. She sold $5 million from tickets. So at the end of the 8th concert, we debit cash $5 million and we credit unearned. I'm sorry, before the concerts actually happen, we debit cash $5 million and we credit unearned ticket revenue $5 million. It's unearned because the concerts have not yet occurred and we were paid up front for the tickets. Yep. So then Selena goes and performs one of the 8 concerts on October 31. We debit ticket revenue, $625,000, and we credit ticket revenue, $625,000. Unearned ticket revenue goes down, $625,000, and ticket revenue goes up, $625,000. How we got $625,000? $5 million times 1/8. 1/8. Okay. The 1/8 represents 1 out of the 8 concerts. Short-term notes payable. I had mentioned that sometimes the business might need a small loan from the bank. Yeah. So sometimes the business doesn't have enough cash on hand. It happens from time to time. Sometimes it happens because our customers don't pay us on time, or we over leveraged ourselves with cash, and so we need some cash. We got need cash to operate the business. So sometimes the business comes cash strapped. So what do? Go to the bank. Say, hey, I need a short-term loan. Give me a short-term loan. I'll pay you back within the next 3 months. No problem. So the bank does it. It's called a short-term notes payable. Another reason why this might happen is because sometimes we, might be overdue on an account payable. Oh, dang, I forgot to pay that vendor for the past 3 months. The vendor comes to me and says, hey, listen, you forgot to pay me over the past 3 months. I'm going to have to convert your account payable to a note payable, which means not only do I owe them the original amount, I also owe them interest. So that's what a note payable is. It either comes from an overdue account payable, they haven't paid on in a couple months, and the vendor says, hey, you owe me some interest on top of that. Or it comes from borrowing some money from the bank. So, you got to cover some cash stuff, right, for the business. But in most cases, either way, they include interest. It's a loan. You got to pay the loan back with interest. And it's usually for a specific amount at a specific date and time in the future. Here's an example situation where we were overdue on paying one of our vendors. Okay, I got a vendor who supplies me with my inventory, and they sent me the bill, but I forgot about it. Okay, I forgot about the bill, so I got to pay the vendor back. So the vendor comes to me and says, "Hey, you're 3 months past due. So I'll make a deal with you. If you can give me a little cash now, I'll take the rest of what you owe me and convert it to what we call a note payable." So I says, well, that's a good deal. I think I'll do that. So here's what happened. I sent my vendor $100 cash. I owed them originally $600. Yeah. So he says, hey, give me $100 cash up front, and we'll convert the rest to a notes payable. So I agree to that. So what we do is we convert the accounts payable to a note payable. And the way we do that is we debit accounts payable, the $600 that I owe the vendor. I credit cash because I gave them $100 cash up front. Keep them calm. And I credit what we call notes payable, which now is basically a short-term loan. And the agreement was that I made with my vendor. I said, hey, listen, I'll give you that $500 remaining. I'll agree, and I'll do that within 2 months, 60 days, at a 12% interest rate. 12%, yeah, I know. Well, the thing is, short-term loans, usually the interest rate's pretty high, so 12% is probably accurate. So this is the entry I make. Debit accounts payable, credit the cash, $100 that I gave them, and I credit the remaining balance to notes payable, $500. Now remember, $500 is what I still owe them at 12% interest within 60 days. So here's the way it works. Now we're at 60 days, October 22nd. Okay, 60 days went by, 2 months went by. I got to pay them now. So I debit notes payable $500. I credit interest expense $10. And I credit cash $510. How I got $10 interest? The interest is calculated by taking the principal amount. Principal amount. Word principal means the balance, yeah? Principal amount. That's the amount borrowed. Principal. Principal amount, in this example, $500. Times the interest rate. The interest rate in this example, 12%. Okay. So it's principal times interest times time. This is where it gets fun. Principal, $500, times interest, 12%, times time, 60 days. How do we calculate days in this formula? The way it works is we take each day into account. 60 over 360. Now I can already hear you. Dr. B, there's 365 days in a calendar year. What are you doing? It says 360. Let me explain to you. There are only 360 banking days in a calendar year. 360 banking days in a calendar year. What I mean by that is there are 5 federally recognized bank holidays in a calendar year where no banking occurs. They're on holiday. So that's why 360, not 365. So again, how do we calculate interest? We take the principal amount times the interest rate times the time. It's whatever number of days divided by 360. That's the time. Make sense? You'll understand the interest expense formula?
Yes.
Okay. All right. That's what I like to hear. Okay. So $10, credit cash 600 because I'm sorry, 510. So I'm paying the principal amount plus the $10 interest to my vendor. Happens from time to time, you know. Sometimes we got to go to the bank for a short-term loan. I need a couple $1,000s in order to help to finance my business, right? I need some cash on hand. I'm a little strapped, so I go to the bank. I borrow $2,000. Bank says, hey, no problem, Dr. B. You can borrow $2,000. The interest rate's going to be 12%, and you owe us the principal plus the interest within 60 days. It's a short-term loan. You know? So when I receive the cash from the bank for the loan, I debit cash $2,000. I credit notes payable $2,000. And you see the note. It says borrow $2,000, 60-day note, 12%, $2,000 principal. So 2 months goes by. Okay, 2 months goes by. I'm going to pay the loan back. So I debit notes payable 2,000. I debit interest expense $40. How I got $40? The principal amount times the interest rate times time. Principal amount times the interest rate times the time. Principal amount $2,000. Interest rate 12%. The time 60 days. It's 60 over 360 banking days in a calendar year. That's the formula. Principal balance times interest rate times number of days over 360 equals the interest amount. In this case, $40. So I debit interest expense $40. I credit cash $2,040. Now, here's the thing. Let's say you borrowed a note, short-term note, at the end of the year. Let's say you did it in December. And your business follows the calendar year, right? So you're going to cross over into the next accounting period, right? So remember the matching principle. Matching principle states that I must recognize revenue and expenses when they were incurred. Okay? If I take out a loan in December and the loan needs to be paid over 2 months, that means it's not due until the end of January. Okay? When that happens, at the end of December, I need to make an adjusting entry to recognize and record the interest expense incurred through the end of the year. So the way I would do it is I would take, if it's 60-day note, took it out December 1, it's due at the end of January. That first 31 days, which is December, gets recorded as the interest expense. That's just an example. Here's another example. Or this is the same example, similar example. Let's say I took out the loan on December 16th, middle of December. Well, that means there's only 15 days left in the year, so I need to record the interest expense for the 15 days. Yep. And the way I do that is at the end of the year, I'll debit interest expense $10 and credit interest payable $10. How I got $10? Principal balance times the interest rate times the time. Since 15 days have passed, it's 15 over 360. That's how I got $10. Now, when the loan is due on February 14th of the next year, the NRE changes. I have debit interest expense, $30. The $30 comes from the remaining amount of time. It's the principal times interest rate times the remaining time, 45 days. 45 over 360, that's the time. So the interest expense for 2020 is $30. Then I debit interest payable. What this does is we're taking out the what we owe in interest that we accrued in the previous accounting period, the $10. Okay, so yeah, I owe $40 in interest. But I already accrued $10 of it in the previous year. That's why you see interest payable $10. And then I debit notes payable, the principal balance, the principal amount, $2,000, and then I credit cash, $2,040. So that's what happens when a loan goes over 2 different accounting periods. Everyone good so far with liabilities? Understanding the calculation for interest? Good, yeah? Still wait? Now we're going to talk about the real important stuff, in my opinion. Payroll. Payroll. Let's talk about payroll. Payroll. Everyone likes getting paid, especially for getting paid for work. Yeah. We work, therefore we get paid. This is called payroll. Payroll liability comes from the wages and salaries and employee benefits and the payroll taxes that have accrued throughout the period, right? Throughout the accounting period. Payroll liabilities doesn't just include the wages. It also includes any benefits like paid time off, family leave, whatever else, holidays, and then the payroll taxes. Yep. Because the employer handles the taxes on your behalf, right? So when you look at your paycheck, it looks like this. Okay, nice visual representation. It looks like this though. So here's how your paycheck works. At the very top of your paycheck, you're going to see this thing that says gross pay. Gross pay is very simple. It is the hours worked times the pay rate. So let's say you earn $20 an hour. Okay? It's $20 an hour times the number of hours that you worked during that payroll period. So if it's 2 weeks, let's say you're full time, and you work 2 weeks at $20 an hour, it's 20 times 80. 80 hours, yeah? 40 hours for week 1, 40 hours for week 2. So 20 times 80. That's your gross pay. Okay, your gross pay. So let's say your gross pay, again, $20 an hour times 80 hours. That's $1,600. Okay, $1,600. That's your gross pay. Then we have all these freaking deductions. This is the part that drives me nuts because that 1,600 is going to get whittled down real fast. Here's how it works. So you got your gross pay minus all your deductions. Minus all your deductions. Your deductions include, but are not limited to, federal income tax. The feds, Uncle freaking Sam wants his cut. Okay? So Uncle Sam takes 20-ish%, right? And then the state, DC government, they want their cut. Okay, so there goes another 6%, right? And then, sometimes the city tax. And then we have what we call, quote unquote, voluntary deductions. Voluntary deductions are pre-tax. Pre-tax. What I mean by that is your voluntary deductions come out before any of the taxes come out of your paycheck. Okay, so gross pay, first usually voluntary deductions, and then all of the taxes. Okay, so voluntary deductions. Can anyone give me examples? What kind of voluntary deductions might you see on your paycheck? What kind of money comes out of your pay for voluntary deductions? Who can tell me? Give me some examples. Come on, y'all wanted this class to be more interactive. That's what we're doing here. Who can give me some examples? Voluntary deductions.
Health insurance?
Yes, Johnny. Health insurance. That's a good one. What else? Voluntary deductions.
401ks?
401k, retirement. Exactly. Health insurance, 401k. Some might have child support. Health insurance, 401k, child support. You might have,
City?
yeah, which one? What was that one again?
Isn't this Social Security?
Social Security. No, that one's not voluntary. You have to pay that. Now, unfortunately, you got to pay Social Security. That one comes out regardless. So voluntary deductions include things like contributions that you make to your retirement, 401k, 403b, 403c, Roth IRA, etc. You might have medical insurance that you have to pay for out of your paycheck or contribute to. Medical, dental, vision. You might have child support that comes out of your paycheck. You might have garnishments. You might have whatever else, right? The other things. So that comes out first. And then the federal income tax comes out. And then the state income tax comes out. And then the federal, I'm going to screw this up, Federal Insurance Contribution Act, FICA, Federal Insurance Contribution Act. That includes Medicare and Social Security. Medicare, for those of you who don't know, Medicare is when you get old, okay, old. When you reach a certain age, I think it's like, in the United States, I think it's like 67-ish. You're eligible to receive Medicare. Medicare is a form of government medical insurance. But we pay into that when we work, yeah? And the last one, of course, Social Security. Social Security, the way to think about Social Security is like a government required savings account for yourself. You contribute to Social Security when you work, when you retire, probably when age 65-ish, 67-ish, you can collect Social Security. It's all the monies that you paid in when you were working. Those are all the things that come out of your paycheck. So gross pay minus voluntary deductions minus federal income tax minus state income tax minus Medicare minus Social Security equals net pay. Net pay, so it's gross pay minus all of the deductions equals net pay. Net pay is what you actually get in the bank account. So we go from the $1,600 I showed you earlier down to about $800, maybe $900, depending on who you ask. So FICA, Federal Insurance Contributions Act. I did say that right. Wow, amazing. Social Security. Back in 2018, if you earned $128,400, you had to pay 6.2%, and then it goes up from there. Below that 128,000, I think it was like 5%. Don't quote me on these things. It changes every couple of years. These days, it's probably higher than that. It's probably closer to like 7%. Check the IRS; they'll tell you. Or just check your pay stub. It should be on there, the percentage. And then the federal Medicare. The Medicare 1.45% of all wages. I think that's even higher now. I think it's closer to 2%. So I want you to also know that, yes, of course, you pay the federal and state income taxes. These are withheld from your employer. Your employer holds these on your behalf. So every hour that you work, you have to pay the federal and state income tax. Yeah. The employer holds those wages for you, those taxes for you, into an account called wage taxes payable. Wage taxes payable. So the company takes the taxes out of your paycheck, puts it into wage taxes payable, and then at the end of every 2 weeks, they send the monies off to the federal and state governments. It's called withholdings. The employer withholds the taxes for you and then remits it to the federal and state governments. Voluntary deductions, health savings accounts, union dues, pension contributions, retirement, insurance, charities, etc. Here's an example. Here's an example. This employee here, their gross wages for the 2 weeks was $2,000. Okay, so I have an employee worked 2,000 hours. I'm sorry. No one works that much. My employer worked 80 hours. That's 40 hours per week for 2 weeks. It's 80 hours. She's full time. Okay. So she worked 80 hours for 2 weeks. Her salary is $2,000 for her 2 weeks worth of work. So she's probably averaging about $21.50, $22 an hour. So her gross pay is $2,000. But that's not what she receives. Okay. We gotta pay the taxes. So she pays into Social Security at 6.2%. That's $124. We got 124 by taking the 2,000 times 0.062. 0.062 is 6.2%. $124. She paid into Medicare taxes, $29. That's 2,000 times 0.0145, $29. She also had to pay her federal income taxes, her medical insurance, union dues. So we take all those out of her gross pay. So 2,000 minus 124 minus 29 minus 213 minus 85 minus $25, giving us her net pay, $1,524. That is our salaries payable. That's what we're going to pay her. So her gross pay, $2,000. That's salaries expense. And then we credit all of the payables. Social Security, Medicare, federal income, state income, medical, union dues. And then the remaining balance goes into salaries payable. The salaries payable is what we actually pay her. So then 2 weeks later, we pay her, debit salaries payable, her net payment, and then we credit cash. Make sense? That's how it works, y'all. That's how your paycheck works. See, I told you you'd like it. Well, not like it. No, no one likes to pay taxes, Johnny, but we pay them. Okay, so those are the taxes that y'all pay. Y'all pay them taxes. But the employer also pays into the system. So y'all pay your federal taxes, your state taxes, uh, your Social Security and Medicare. The employer also has to pay the Medicare, the Social Security, and then they also, in addition to those things, which they match. So for every dollar that you pay into Social Security, your employer has to match that. They pay the same exact amount that you pay into your Social Security. The other thing that they have to pay is Medicare. They have to match every dollar that you pay into Medicare, they have to pay into Medicare. But in addition to those two things, the employer also has to pay what we call federal and state unemployment insurance taxes. Unemployment insurance taxes. If you ever become unemployed for whatever reason, a pandemic hits and all of a sudden you're unemployed or whatever, you file for unemployment. Where do you think that money come from? Tell me. Who can tell me? Where does the money for unemployment come from? That's my question to you. Where does the money that you received from unemployment, where does that money come from? Who paid into that account? Who can tell me? Who paid into the unemployment account? Who can tell me?
Everyone?
Everyone? No. No, not everyone. I wish it was. It doesn't work that way. Who paid into the unemployment account?
The employers?
The employers. Thank you, John. Your employer pays into the unemployment account on your behalf. Okay? So if you ever declare unemployment, you file for unemployment, just know that the money came from your employer. Okay? And it's based off of the amount of time that you work. Okay? That's not everyone gets the same amount of unemployment. It doesn't work that way. It's based off of the amount that you work. So if you only worked a little bit, guess what? You're only going to get a little bit of unemployment. If you worked a lot of bit, you'll get a lot of bit. Okay? But that's how it works. Yep. So for the federal and state, it's based off of the amount that you work, and the employer, your employer, pays into the federal and state unemployment taxes that then go to you whenever you decide to apply for unemployment. But yeah, that's how it works. The rates may have changed a little bit over time, but the concept's still the same. So at the end of each month, the employer records what they pay into match you. They match you on your Social Security and Medicare. Okay, so our employee in the other example, she made the $2,000 net. The employer also has to match the Social Security and Medicare. So 124 and 29 is what the employer matches. The unemployment taxes, that's just for the employer. So $108 for state and $12 for federal. So we debit payroll taxes and then we credit all of the payables. State unemployment, it's the gross pay times the percentage, whatever the percentage is for the state. And the federal unemployment, it's the gross pay times the percentage for the federal government. And we do that for every pay period and for every employee. That's why some companies, payroll, it's its own department, or it might be its own department, or at least one person that does it, especially for larger companies. It's important that the company has a system of internal controls for payroll. Don't screw around with payroll. You business owners out there, don't screw around with payroll. That's the most dangerous thing you can do to your business. Okay? If you have employees, you have to do these things. So I promise you, you're going to have problems in the future if you don't. Employee hiring, payroll preparation, timekeeping, and payroll payment. These are all things that you have to have separated and monitored individually. My recommendation is always to have a separate bank account just for payroll. In some cases, in some states, it's required that you have a separate bank account for the business that is just for payroll. And you have to have a certain amount of cash in there at all times. But that's also a best practice for those of you listening that own your own business. Multi-period liabilities, these are periods, includes unearned revenues and notes payable for longer periods of time. Unearned revenues, as you know, are funds that we've collected from our customers but have not yet provided the good or the service. And this could cover longer periods of time. An example of that would be a magazine subscription, or let's say you have the lawn service business that goes over multiple accounting periods, right? They paid you in advance for a whole year, say. That would be a situation where it will go over multiple periods. And then, of course, another example is a note payable that's longer than 1 year. And we talked about this earlier. Examples would be a mortgage, a car loan, student loan, things greater than 1 year. But we'll talk more about long-term payables in the future. I think next week we talk about that one. Other liabilities that we need to talk about. Estimated liabilities. Sometimes we don't always know, but we know that there might be a liability for something. So we can estimate those liabilities. Example, let's say that you have a business where you sell products and those products have warranties on them. Warranties. An example would be a car. Okay, let's say you're a car salesperson and you own a dealership and you sell cars. That's your job. And the cars that you sell, they might have a 60-day warranty with the dealership. Bring the car back to me within 60 days if something's wrong with it, and I'll fix it. It'll be covered under the warranty. That's nice. Okay. We don't always know when a repair under a warranty will come in, or if it will ever come in. And so we estimate that a certain amount will come back as a warranty repair. That's how we can estimate a liability. Pensions, healthcare, vacation pay, warranties, these are all things that could be estimated as liabilities. Healthcare and pensions. Pensions for those of you who don't know, are benefits that are offered by employers, typically government employers, government agencies. They might offer a pension program. A pension is a guaranteed payment in retirement for a period of time. It's usually for the remaining life of the employee. So, and sometimes they might also include medical insurance. Once you're retired. Yeah, sometimes that's a nice benefit. Not a lot of places do that anymore, but some do. Anyway, the employer can assume that 10% of their employees will collect the pension for the employees earning $120,000, we'll say. So 10%, we're talking $20,000. So employee benefits, we debit $20,000, we credit the medical insurance and the retirement programs payable. Okay. Reason why they're payables is because we will pay them we pay the medical insurance on behalf of the employee, and we also will pay the employee when they retire. Vacation benefits is another one that we can estimate. We estimate that for every year our employee works, that they will take 14 days of vacation time. So we accrue the vacation benefit. We debit vacation benefit expense, and we credit vacation benefit payable. When the employee decides to take a vacation, we debit vacation benefits payable, and we credit cash to record the days off that they took. We pay them for those days off. Sometimes you might get lucky and work for an employer that will pay you a bonus. Ooh, bonuses are nice, aren't they? It's just extra cash. Hey, sweet. I'll take a bonus. So let's say the company pays out a bonus to be shared by all of the employees. The bonus was for $10,000. So we debit employee bonus expense and we credit bonus payable. For warranties, let's say that we sell a product that can be warranted, such as a car. They come back within 60 days, we will repair the car because it's under warranty. That's what a warranty is. It's an obligation to repair or replace the product if it fails within a specific amount of time. So we can estimate that some customers will take advantage of our warranty. So here's an example. December 1, we sold a car for $16,000. It has a 1 year or 12,000 mile warranty. And the warranty average has been about 4% of all of our sales. The customer will come back for a warranty, about 4%. So that's not too bad. So we take the 16,000 times 4%. So this is how we estimate the warranty. We debit warranty expense, $640. The $640 came from the 16,000 times 4%. Debit warranty expense, credit warranty payable, or warranty liability, sorry. If the customer comes in for a repair and it's under warranty, we debit the estimated warranty liability and we credit the parts, right, the inventory. A few last liabilities we need to talk about. Contingencies. This is called a contingent liability. If a future event occurs, we need to record the liability. If a future event is highly probable of occurring, we can either estimate or non-estimate the liability. Estimatable liabilities, example, a warranty, it's highly probable that the customer will have a warranty claim for about 4%. If it's possible, but not too likely, that the customer will come back, we can just disclose that in the notes of the accounting statements. If there's no possibility or very little possibility of something happening in the future, then we don't disclose anything. That's what we call contingencies. Contingencies usually contain legal claims. A potential claim is rendered in the amount that can be reasonably estimated and paid for damages if it's a probable cause. Debt guarantees are usually disclosed in the notes, and other contingencies are also disclosed. Again, contingencies, if there's a possibility of something happening, then we disclose it. If there's a strong possibility of something happening, then we estimate it. If there's no probability of something happening, then we don't do anything. And of course, it wouldn't be a lesson without at least one ratio. This one's called the times interest earned. The times interest earned tells us about the risk of return or the inability to pay interest times interest earned. We take the income before interest and income taxes on the income statement. That's a line item on the income statement. Divided by the interest expense, also a line item on the income statement. And that'll give us the times interest earned. Interest before interest and income taxes, $150 in this example, divided by interest expense, $60, 2.5 times is the times interest earned. A couple of reports that you as employers need to be aware of. For payroll, is you fill out a W-4 for payroll processes. So when you're first hired, you fill out what's called a W-4. It's a wage form that you tell the employer what your deductions are, yeah, or withholdings. If you have 2 kids, then you put 2 as your deductions, yeah. For example, so that's payroll procedures. The payroll report at the end of each year, you as the employee, you receive a W-2. The W-2 tells you about the wages that you earn throughout the year, and also tells you about the taxes that have occurred throughout the year. Employers fill out what's called an IRS Form 9040 and a 9041. For payroll records, we track the payroll register, payroll checks, employee earnings reports, and those are the kinds of reports that employers would see. And at the end of each year, we prepare adjusting entries for our taxes, debit income tax expense, credit income tax payable, and then on April 15th, we record the payment. We debit income tax payable, credit cash, and at the end of each year, we record any accruals and liabilities. Any comments, questions, or concerns about liabilities or payroll? Liabilities or payroll? Good? You all feel good about a short break?
Yes.
Okay, I'm down for a short break as well. So let's meet back here at 12:35.